what you need to know to stay profitable using Wyckoff volume spread analysis. I am going to be using live charts in this seminar. I am going to be using futures and Forex, and you're going to see actual alerts that have come in from the Trade Guider program in Forex at the moment, and also an alert in futures. But before we get there, I've got a lot to cover, so I'm going to get straight to the point. So I want to read a disclaimer to you, which is very important because we're a registered entity here in the United Kingdom. Important disclaimer: trading stocks, options on stocks, futures, options on futures, and retail off-exchange foreign currency transactions, Forex, involves substantial risk of loss, and it's not suitable for all investors. Past performance, whether actual or indicated by historical tests of strategies, is no guarantee of future performance or success. There is a possibility that you may sustain a loss equal to or greater than your entire investment, regardless of which asset class you trade: equities, options, futures, or Forex. Therefore, you should not invest or risk money that you cannot afford to lose. Trade Guider Limited is an authorised representative of Forex Max Limited, and we're regulated by the Financial Conduct Authority, number 229906. So let me introduce myself to you. My name is Gavin Holmes. I'm the author of Trading in the Shadow of the Smart Money and the Complete Volume Spread Analysis System Explained. And I'm also the head trader here at the Wyckoff Williams Investment Portfolio, which is a private fund which will be launched later this year. I've been now trading for 16 years and was very lucky to have met a guy called Tom Williams, who taught me everything I know. He passed away, unfortunately, in November of last year at the grand old age of 87. But he was a former syndicate trader or an insider. And what I'm going to ask you to do today is to use your mind like a parachute. A parachute is best used when it's open. But I wasn't always from a financial background. In fact, I started my career as a police officer here in Hampshire, where I'm back. I used to live in Chicago for 15 years, but I started my career, obviously, with a surname like Holmes, H-O-L-M-E-S. You can imagine that always got a laugh when Detective Holmes was asked to give evidence in Crown Court. They were always looking for Watson, but never could find him. But that was my career until I was injured on duty after 5 years of service, and I had to be retired. So my whole life's dream as a kid to be a policeman was then completely in tatters. And I do believe, however, in life, you're sent on a journey. We all have a mission in life. Clearly mine was not being a policeman, telling me that I made the right decision to get out. Having said that, though, I was very blessed, because 16 years ago I met a gentleman called Tom Williams, and I started my own businesses after I left the police. I ran an exhibition design company, and I ran a jewellery company. But it was through the exhibition design business I started an internet company that led me to meet Tom Williams, who was a former, as I say, syndicate trader. And through his work, this is Tom here. As I say, unfortunately, he left us in November last year, but he left a legacy which I now carry, which is to teach people the truth about the financial markets. Now, most people here today will want to know how to make money in the financial markets. So this is me, Gavin, and I go all over the world. I've done thousands of presentations, both online like this and live. Recently, the most recent one, I traded live at the Chicago Mercantile Exchange in Chicago, where I married my wife. In fact, we've got 2 young children. And this was on the 19th of October, and we launched our hedge fund software, which you're going to see today, running live at the exchange. And I was able to trade in front of a large group of people with real money and show the trades as they were happening with the logic behind why the trade set up. But I am aware that most of you here will want to know, well, I'm just giving you my time, Gavin. I've heard a lot of presentations. Will you show me something different, something that can prove that you can make it in the market? Because I believe anyone can make it in the market if they get rid of their bad habits and if they understand the truth about how the markets actually work and how they operate. Many people, unfortunately, don't. Now, what I'm going to teach you today is something called the Wyckoff method, or volume spread analysis. And I'm going to give you these articles. I'm not going to read all of them, but we have 2 customers who entered competitions, the World Cup Trading Championship, which is real money with real results. Now, one of those customers here was Earl Ehrenler, actually a friend of mine here who I've met now. And Ehrenler came second in the World Cup Trading Championships, trading futures and commodities. And I just want to read this to you. He talks about Wyckoff, and he says, in his studies of the markets, Ehrenle came upon Master the Markets by the late Tom Williams. He began using the methods from this book in June of 2007, and he credits his reliance on this approach, which includes Wyckoff theory, as one of the reasons he began to see consistent profitability in his trading. Since the end of 2008, Ehrenle has been trading full-time. This is his first year in the World Cup Championship of Futures and Forex Trading. I'm going to give you this article, so don't worry, I'm not going to read all of it. But the second article I want to read to you is from somebody, again, from the United Kingdom, who is an investigative journalist, or was, but took up Forex trading. And his name is Tim Raymond. And again, you're going to get a copy of this article, so you can read how a trader, or how this gentleman not won the World Cup of Forex trading once, but won it twice, one year after another, using the method I'm about to show you. And in case you don't believe that, I'm going to read to you the paragraph here. But I do suggest when you get this article, you read all of it, because it's a wonderful story about how you can make it in the market if you understand the truth about the market. In 1998, Raymond had the good fortune to connect with Tom Williams, the creator of volume spread analysis, which I'm going to teach you today briefly. I rang him and he was very reluctant to sell me his software. He said, trading's very difficult, you know. I insisted and agreed I'd pay £5,000 in instalments, Raymond says. These days, if I'm asked by someone who's starting out in trading for advice, the first place I send them is the TradeGuider website. For me, it demystified the markets to a great extent, Raymond says. Tim Raymond won a Forex competition using volume. Most traders don't think volume is even relevant in the Forex markets. But I'm going to show you today, in fact, it is relevant in all markets. And I will make sure you get a copy of that article. Now, very briefly now, because we've got very little time, I'm going to play you a short video. This is going to set the scene for what I'm about to show you. Please pay attention to it, even if you've seen it before, and watch very closely what happens when Maria Bartiromo, who's an anchor on CNBC, talks about market manipulation, which is today's subject. But again, I want to be clear here. Whilst I'm going to show you some things today about how the markets can be rigged, I'm going to show you how you can benefit and stay profitable by understanding where the footprints are on the chart. And I'll prove to you and show you that they are there. Forgive me if I sound like a policeman, but I always, when I do these presentations, imagine you are the jury and I'm the officer giving the evidence. And so, here is Detective Holmes with the evidence, and we start with this short video.
What is a smart trader? A smart trader is someone who knows how the markets really work. They know how they move, why they move, and who and what moves them. Armed with this knowledge and understanding, they can trade in the markets alongside the major players. Smart traders are in the minority. The majority of retail traders and investors do not have this information. They rely on technical analysis and fundamental analysis to predict market movements. The problem for them is that on their own, these tools and methods don't work, which is why the large majority of traders lose to the markets. Remember, the market needs losers, many of them, so that the informed minority can win. Today, we'll show you how you can become a smart trader, trading in harmony with the professionals rather than trading alongside the herd. So why do so many traders lose? They lose because they've not grasped some fundamental facts which drive all markets. Fact number one. By far the largest players in the market are the hedge funds, investment banks, trading syndicates, such as Goldman Sachs, George Soros, and Berkshire Hathaway, headed up by Warren Buffett. These are organisations you've probably heard of, but there are many others which aren't publicly known. Together, they're by far the biggest players in the international trading community. At TradeGuider, we call them the smart money. Fact number two. The smart money have to make money, and they do this by selling at the top of the market and buying at the bottom. Fact number three. In order to do this, they have to move the market so that the prices rise to the top or fall to the bottom. So, how can they move the markets? Tom Williams, inventor of volume spread analysis, was a syndicate trader in the US and is one of the very few smart money traders to spill the beans on how the markets really work. He explains how the markets are moved.
Well, the thing is, you see, if you're a professional trader, you've got to do your utmost to buy on low, depressed prices. And the best way to do that is to create bad news, put out rumours, do whatever you can, seize the opportunity of some serious news coming in, and then the market's markdown hopefully shakes people out of that. There was one example that we used to get up to all sorts of so-called tricks. I mean, we used to trade Teledyne. And Teledyne, the actual company, used to have an annual general meeting in Beverly Hills. And we used to plant people in there, in the meeting. There'd be quite a large room with perhaps several hundred people in there. And all the directors would be sitting up on the stage, you know, behind the table looking out at you. But we'd have planted questions to rather encourage people either to buy or encourage people to sell. We'd be asking awkward questions like we might stand up and say, is this correct? We've heard secretly that you've got a huge order from Saudi Arabia for your products. And of course, it was a complete fabrication. Then the directors would look at each other and sort of shrug their shoulders. But the audience heard that and they think, aye, they've got something going on, they're keeping it secret. And that would definitely have a nice big surge of buying next day. If you were distributing, we'd say, sure, we'll let you have it all. Because we've bought in the lows, we're now encouraging people to come in and buy it off us. That goes on all the time, that type of thing, if the opportunity's there.
Markets have always been manipulated. Here's just a few examples. Let's begin with the British Petroleum oil spill disaster in 2010. On the 25th of June that year, the shares fell to just under $27. The news was grim, and the pundits and reporters were talking in terms of huge losses and a possible breakup of the company. And everyone who had shares was looking to sell in full expectation that prices would plummet. And sell they did, straight into the hands of the smart money professionals who bought cheap. Within 6 months, the price of the stock doubled. Buy cheap, sell back when the market rises. And that's how the game is played. On May the 6th, 2010, something very strange happened in the financial markets. This day is now referred to as the flash crash, because no credible explanation has been provided by the regulatory authorities as to exactly what caused the crash or who was responsible. In fact, many investors begin to suspect that all was not what it seemed to be. CNBC's closing bell anchorwoman Maria Bartiromo was reporting on the day the flash crash happened. Fellow reporter Matt Nesto was explaining some unusual anomalies in a number of stocks, even though the mainstream media claims that it was caused by a lone trader hitting the wrong button, B for billion instead of M for million. Maria saw through it straight away.
A penny. So those are at least 8 names that they're going to have to track down on top of the Accenture trade, where we have the stock price intraday showing us at least, we'll assume, a bogus trade of 0.
That is ridiculous. I mean, this really sounds like market manipulation to me. This is outrageous.
It happens a lot, Maria. It really does. I mean, we could probably ask the NASDAQ. They may not want to say exactly how often it happens, but it happens frequently, and they go back and they correct. And the thing that stinks is if you, in good faith, put in a trade and made money and then lost it, you lose it.
What we actually witnessed on May the 6th was a giant shakeout of the market. The smart money were expecting higher prices and wanted to catch the retail traders by marking the price down heavily before moving the price up. They were bullish, the stocks were going to rise, and they wanted to buy at the best possible price. Wouldn't you want to do the same? Buy it at the lowest price, knowing you could sell it later for much more than you bought it for. Qantas soars to record half-year profits is the headline on February the 23rd, 2016. Lower oil prices have helped Qantas post a record pre-tax profit, and best first half profit in the Australian Airlines 95-year history are used directly below the headline. All the news is bullish. The stock has been going up and up because it's in an uptrend. To the retail trading and investing community, this appeared to be a great opportunity to buy the stock because everything lined up. And if you didn't go into the market by now, you'd miss the move. Okay, so buy. What happened? The stock plummeted spectacularly, and the uninformed retail traders said bye-bye to their capital. That's the trading game. Buy low, sell high. Be a predator, a clever predator that understands exactly how the prey think and act. Smart traders appreciate this and understand that quite often all is not what it seems. The media, the sentiment and the emotions will often lead to poor trading decisions and big returns for the professionals. The good thing is that whilst the smart money try and disguise their activity, there's one place where they cannot hide: the price chart. And in this presentation, we're going to show you how to read the footprints left by the smart money on any price chart, whether it's a currency pair, a stock, commodity, or a derivative of some sort. In the next few hours, we're going to show you how the interrelation of price and volume can help us determine whether the smart money is buying, selling, or not participating. And it's this interrelation which forms the basis of the volume spread analysis methodology. We'll show you how you can identify the tops and bottoms of a market in foresight, not hindsight. We'll show you how you can use the three-stage trading process, scan, confirm, trade, to form the basis of a powerful trading strategy, so that you can trade in harmony with the smart money. We'll show you techniques that will help you manage your risk and optimize your trading. We'll show you why the media is key, and how to trade the news and the volatility often caused by it. In the next few hours, you'll learn things which will enlighten you as to how the markets really work. And you'll discover knowledge that only a small fraction of the trading community know and understand. So what...
Okay guys, thanks very much. That was actually a video that we produced for our roadshow that we did last year with Active Trades, but it's relevant. So let's get straight to the point. So what is trading in the shadow of the smart money? My book is all about. Simply, you learn to trade in the same directions as the big players. And the big players, by the way, you know, when they want to buy, they don't buy as the price is going up. They buy as the price is going down, as I'm going to show you. And when they're selling, they don't sell as the price is falling. They sell as the price is rising, which is why so many traders and investors who are using mathematical formulas fail. Because when the mathematical formula, as the market goes up, tells you to buy, you're ending up buying a top most often, and then it'll collapse. And very often, as the market falls, you go short, you think, I must be right, it's really falling very quickly, and just as you go short, the whole thing goes back up and stops you out. How many times does that happen to retail traders and investors? It happens a lot. Now, what I'm going to teach you today in this very short presentation is how to recognise the footprints of professional money. What I'm going to show you today, and you're going to get a copy of this article as well, is the trading method that the smart money actually don't want you to know about. This was written in the Business Insider magazine. It says, presenting the secret trading, I don't think it's a secret, by the way, presenting the secret trading strategy from the 1930s that hedge funders don't want you to know about. And it talks about a trader called Richard DeMille Wyckoff, who was a legendary trader who in the 1930s wrote a manifesto that gained him a cult following on Wall Street. In his 1931 book, which is still relevant today, by the way, I've got a copy of it on my shelf here, The Richard D. Wyckoff Method of Trading and Investing in Stocks, a course of instruction in stock market science and technique. It's out of print, somewhat difficult to find these days. But even in 2013, when this was written, hedge fund managers still swear by it. One of the key takeaways from the book, that is, if you want to succeed, you have to learn to recognise the professionals and understand what they're doing. That's what those who follow Wyckoff do. They've watched the large operators. Wyckoff walks us through the process of how a large operator will manipulate a stock up or down, so that next time one sees it unfolding on the screen before his or her own eyes, he or she can react accordingly, which is about what I'm going to show you today. When you see a manipulative event happening, how to recognise it and profit from it. This is not a conspiracy theory. This is a fact. So let me ask you all a question. Just type in yes or no into the chat window. Do you think the financial markets are manipulated? Yes or no? Just Y or N. Do you think the financial markets are manipulated? Okay, so there's hundreds of people here. So far I've seen one no out of everyone that's typed in. 2 no's. 3 no's. And about 30 yeses so far. And a lot of course it is. Okay. Well, look, let me just start this presentation here, as I prove to you this, that first and foremost, this is not a conspiracy theory, right? I'm not here to create conspiracies. I'm here to show you that A, this is a reality of trading, and B, it's very good news for traders and investors that can recognise what's going on a price chart. So let me give you some evidence now. Remember, I said the ex-policeman coming in. Let's look at the BBC website, very well-renowned website. This is a book by Michael Lewis, great book on my bookshelf as well. Okay, it says the market is rigged. Michael Lewis wrote a book on it, factual, everything was backed up by evidence. In his seminal work on the role of high-frequency traders in global stock markets, Michael Lewis quotes Charlie Munger, Warren Buffett's right-hand man. Mr. Munger said that high-frequency trading was the functional equivalent of letting a lot of rats into a granary. UK flash crash trader appears in court. Well, we've just heard about this, haven't we? Poor guy is blamed for the flash crash in America that you heard in the video, 2010. Billions of dollars wiped off stocks and futures. Come on, we don't believe that one person did that. It was done deliberately. Forex. Oh, we can't rig Forex, but yes, the Forex market has been rigged and is rigged. And in fact, if you look at the LIBOR scandal, that was rigging the Forex market. And in fact, again, the BBC, mainstream media, is reporting this. This is not a secret anymore. CNBC, Forex manipulation, how it worked, mainstream media, and in the article, which I'm not going to read, describes the whole process. So I'm not, if for those of you that said no, I'd say wake up, because this is reality. But it's not bad news, as I'm going to show you. And this is something I'm now going to prove to you, how volume is key to recognising trading opportunities when a market is manipulated. This is an article in the British newspaper, The Telegraph, from Thomas Pascoe, 2012. And in fact, I've never heard anything more about it in The Telegraph. I believe they stopped this story getting out. The price of gold has been manipulated. This is more scandalous than LIBOR. Brilliant article. Right? Nothing followed up on. Now I'm going to tell you the story of Andrew Maguire. Some of you will have heard of him, some of you won't. But I'm going to show you some charts now. We're going to get into the meat on the bones. We're going to talk about the manipulation of the gold and silver market. Now, Andrew Maguire used to work with Goldman Sachs, and he was a whistleblower. He basically described, in an email to the CFTC in America, which I have a copy of, which I'm going to show you, a manipulative event in the gold market and the silver market, but specifically silver. And he described what was going to happen 5 days before it happened, which means, if that's the case, markets clearly are being manipulated. And it was reported, not in the mainstream media, but by the New York Post, was the only newspaper that actually in America printed this article, and the rest, and they actually tried to get a court order to actually prevent this being printed. And it tells the whole story here of trader blows whistle on gold and silver price manipulation, and it talks about the email that was sent to Eliud Ramirez from the CFTC in America. And this is the actual email, and I'll read it to you. And it's dated February the 3rd, 2010 at 3:18 p.m. Dear Mr. Ramirez, thank you for your response. Thought it may be helpful to your investigation if I gave you the heads up for a manipulative event signalled for Friday the 5th of February. Remember, this is 2010, and remember that date. The non-farm payrolls number will be announced at 8:30 Eastern Time. There will be one of two scenarios occurring, and both will result in silver and gold being taken down with a wave of short selling designed to take out obvious support levels and trip stops below. While I will no doubt be able to profit from this upcoming trade, it is an example of just how easy it is to manipulate a market if a concentrated position is allowed by a very small group of traders. I sent you a slide, a couple of past examples of just how this will play out. Scenario 1, the news is bad, employment's worse. This will have a bullish effect on gold and silver as the US dollar weakens and the precious metals draw bids, spiking them higher. This will be sold into within a very short time, 1 to 5 minutes, with thousands of new short contracts being added, overcoming any new bids and spiking the precious metals down hard, targeting key technical support levels. Scenario 2. The news is good, employment's better than expected. This will result in a massive short position being instigated almost immediately with no move up. This will not initially be liquidation of long positions, but will result in stops being triggered, again targeting key support levels. Both scenarios will spell an attempt by the two main short holders to illegally drive the market down and reap very large profits. Locals such as myself will be invited on board, which will further add to the downward pressure. The question I would expect you might ask is, who is behind the sudden selling, and is it the entities holding a concentrated position? How is it possible for me to know what will occur days before it will happen? Only if a market is manipulated could this possibly occur. Now, let's have a look at that date on a chart. This is a trade guide chart using our end of day program. And if I get time at the end, I'll show you the FTSE 100 and what it shows. It's very interesting. But I may run out of time, we'll see. So we have principles based on volume. Now, at the bottom of your screen is volume. This is what we call volume. And if I look at any charting here, you can see at the moment we've got volume here in the Dow on my charts here. Okay, and you'll see here on the bottom of the screen we have volume. Okay, this here is volume. We have high volume bars, and then over here low volume bars into the same level. Okay, and we can see here that that volume has got a red signal. This volume has got a red signal, and the market is falling. Okay, and I'm going to talk more about this because I'm in a trade at the moment. Okay, on a live trade on this instrument, as we can see. All right, but I'm going to come to that because I'm also in trades in other instruments as well, which I'm going to show you. Now, what I want to talk about though is volume. At the bottom of the screen is volume, and volume is nothing more than the activity in the market. Sometimes it comes from an exchange like the Chicago Mercantile Exchange, the New York Stock Exchange, the London Stock Exchange. Sometimes in Forex, they say, well, there's no centralized exchange. Volume is completely irrelevant. It can't actually work. But that is not correct. You do actually get volume in Forex. And let me quickly show you that as we show you a MT4 chart here running live. And you should very shortly be able to see an MT4 chart here. Okay, and you can see here we've got a long position here, which came in on here, on this signal here, which I'm going to explain to you. All right, and I've got several, as you can see, multiple alerts that have come in using what we call Smart Center Pro trading software. That's what you see to the left, and these are all alerts that are coming in based on volume. But the volume that you see at the bottom of the screen here is known as tick volume. Tick volume, and it works extremely well for Forex. Okay, so back to my thought. Now, can I just ask here, if I may quickly, what do you all currently trade? Can I just ask before I move on, what do you all currently trade? What are you trading? Is it Forex, futures, stocks? Just let me know. Crikey. Simon, it looks like everyone here is trading Forex. so I better get to the Forex charts quickly.
Forex is the theme, yeah, definitely.
It appears to be. Did you just email your Forex traders for this event?
It just seems to be Forex is the one that everybody sort of gravitates towards. I think it's the liquidity, and I think it's the speed and the ease of access. It comes with its risks, of course. But there we are. Yeah, we're ready.
Yeah, no, any trading. Let me just be clear. I gave you that disclaimer right at the beginning, and the disclaimer talks about risk. If you're going to get into this business and you're going to do it full time like I do, and I love what I do, but I'm passionate about what I do, right? But I have days where I lose money, and I have days where I make a lot of money. But the one thing I've learned is to keep on an even keel. And the how I do that is I have a trading plan that I look at every morning, and I look at it again every night. And for those of you that become a customer, you'll get that trading plan. And it helped me greatly because there is a saying, plan to, or fail to plan, plan to fail. And in trading, it's such a true statement. Now, let me show you what happened. And this is a Trade Guide at end of day software chart for silver, okay, SI. It's the silver contract. And I want you to notice, as the manipulative event took place, just like Maguire said, on the 5th and the 6th of February 2010, as per the email that I just showed you. Let me just remind you again on the email. If we look back, here's the date. Okay, it was February the 3rd. He sent this email at 3:18, warning of an event, a manipulative event that was going to happen a couple of days' time. Here's the manipulative event. Look at the volume on these two price bars, right? Massive. As the market collapses through the previous support levels, it takes out all the stops that are under support, and then they buy it back at lower prices. Hence, we get a green signal, and then there's a big rally. And gold went all the way up, or silver went all the way up to $40 after this event. Now, we can see here volume, and I just want you to remember something. Volume is activity. That's all it is. Volume is activity. You might want to write that down, because it's something that I've got in my trading plan. Volume is activity. It's the activity of the smart money, the professional side of the market. 90% of the traded volume is made up of smart money trading. The rest of the 10% is the retail traders and the small traders. There's 90% of the volume. They say approximately, that's an approximation. About 90% is made up of professional money. I call them the smart money because they make money. And then you've got the dumb money that lose money because they don't understand that on down bars, as the market falls and the volume's increasing, if that was all selling volume here, the next price bar, which is a daily chart, wouldn't close higher. It couldn't. If that was all selling volume, that everyone was selling, the market would continue to fall, but it doesn't. They're buying. And if I look here at the down, again, you can see here, look at the volume on this bar, right? As we actually come up this morning, a lot of traders start to get long here because their MACD, their stochastic, their moving average is telling them, hey, the market's going up, I better get long. But that's a mistake. That is no result from effort. If that was all buying in that volume here, we wouldn't close near the low of the bar, right? And this is a 5-minute chart, with the next bar closing on its low. It couldn't happen. Another example here, supply coming in. Now, there's 3 universal laws that move the markets. The first one is supply and demand. Again, you might want to write this down. The second one is cause and effect. And the third one, which you can see here, is effort versus result. There's the effort in the volume, and there's the result in the lowering of price. These are live charts. These are running now. This is the Dow Jones in America. I'm a big futures trader, which is why I work closely with the Chicago Mercantile Exchange and do a lot of educational events with them. Because I love to trade. My favourite instrument to trade is actually the E-mini S&P futures contract, where we've had lots of buying opportunities as the market retraces on very low volume. And I heard the previous speaker saying the same thing. In a bull move, you don't buy on the up move, you buy on the down move. But most traders don't know that. They're not educated to know that, but I'm going to teach you that. So I talk about traders looking for Yao Ming. Who's Yao Ming? Well, I lived in America, as I said, for 15 years, and I worked right downtown in Chicago in a brokerage firm with 50, 60 guys. So I was right in the thick of it. So I could see traders that were losing money, and I could see 1 or 2 that were making money. And I began to see the ones that made money had a certain plan that they followed, and that's the plan we're going to teach you. They weren't using mathematical formulas. They weren't using stochastic or MACDs at all. They were looking at the tape. They were looking at the volume, and they were looking at the activity of the professional money. Simply put, you can get what we call Yao Ming volume, which is massive volume, and then you can get very low volume. And it's very important. Both of them are very important, and they produce in the Trade Guider software program an indicator. It's not a buy-sell signal, it's an indicator, and it's measuring the imbalance of supply and demand in the time frame that you're looking at. So who is Yao Ming? Well, Yao Ming is a very tall human being. In fact, 7'6". He used to play for the Houston Rockets or the Astros, one of the two, and you can see he's incredibly tall. So if you were to stand next to, or my daughter, Olivia, who's about 4 foot now, she stood next to Yao Ming, he'd be nearly double the size. So why is this relevant? Because when you see volume on your price chart, the first thing you've got to look at is what we call Yao Ming volume, or unusually high volume. It's very relevant because it tells you the big banks, the institutions, the funds are becoming active. They cannot hide their footprint in volume. Cannot hide it, and you can see it here. Here's the manipulative event, the highest volume on the chart as they manipulate price, a big green signal says buying's coming in and the market goes up. Here is the signal. It's called a shakeout. It's exactly what happened in the flash crash. It's sign of strength, which is one of our principles, sign of strength, SOS. Doesn't mean save our souls. 56, shakeout. The market gets shaken out. They mark down, they catch all the stops, they buy lower. Why wouldn't you buy lower? If you're running a market stall in London and you're selling oranges and you buy an orange for 20 pence, you can't sell it for 10 pence and stay in business. Same as the financial markets. That's exactly how they operate. And why do so many retail traders lose in the market? They're using the mathematical formulas that just don't work. They're lagging. Volume is not a lagging indicator. It's a right edge indicator, as you'll learn. And all of you in this room for your time are going to be invited to a live trading session with me tomorrow and all of next week with our team. We have a team of traders who trade live money. We're a registered entity. You can see us trading with our Smart Center Pro software that I'm going to show you shortly, and you're all invited, and there's no charge. I'm not going to sell you anything today if I don't have to. Right? There's no sales pitch at the end here at all. I'm going to give you stuff for free because I know when you find this information, you'll be in touch. So the shakeout is exactly what it says. And after we see a shakeout, we look for what we call testing of the market. In fact, we're seeing that in Forex at the moment on several instruments. And here we see it. We have the shakeout in the background on this signal. And then the market retraces, but look at the volume on the retracement here. See as the market retraces down, the volume is lower. That's what we call no selling pressure in the market. There is no sellers because they know that the price of silver is going to rally. And that's called no selling pressure in the market. Okay, no selling pressure. And after a shakeout where you've got massive volume, now low volume becomes very important because as the market falls and there's little volume on it, it tells you, well, the professional money must have already brought, and as the price falls, they're not participating in the downward move. It's very logical. And then, of course, you see it time and time again as the market moves up, you see the same principles apply. Time and time again, the same thing happens. All right? And the same thing happened, actually, at the moment in the Forex market. I mean, we can see the same thing if I just quickly switch over to the charts here. And you can see here, this is the Smart Center Pro. This is the trade alert that came in. And let me just explain it to you very briefly before I move on. This is looking at multiple time frames in Forex. This is specifically MT4 I'm using. And you'll see here that I've got several alerts that have come in today for long trades. One was in the US dollar Japanese yen. One was in the euro Japanese yen, which you can see here. And let me explain to you very briefly, because I don't have a lot of time, why this was a trade set up to the long side. We'll start off with the trade that we've got running here, which is the euro Japanese yen. Now, first of all, you can see that the weekly chart, the W1, that means weekly, is green.
Sorry, Gavin, I think we've lost the screen. We're not seeing anything at the moment. So, have you gone? We must need to change the presenter, I think, back to the other. Which one am I on at the moment?
Right, let me try this one. Hold on a second. That's it. You should be able to see it now. Can you see it?
No, not quite yet.
No. Yeah, don't worry. I can't show it because for some reason it's not allowing me to show that screen. Not to worry. I'll stick with the one that does work, which is that one.
Okay, thanks.
Yeah, you saw it earlier anyway, but I can show you this in the futures market. It's not a problem. It just, for some reason on the other screen, it won't allow me to share it. But what you see here in this instrument is a retracement on low volume. Okay, we call that no supply or no selling pressure in the market. Now, this method that we teach is all based on the work of the man on the right, Richard Wyckoff, and the man on the left that taught me, Tom George Williams. Wyckoff was born in 1873 and passed in 1934. He was a stock market authority, founder and one-time editor of the magazine of Wall Street and the editor of Stock Market Technique. And he said, thousands of those who operate in the markets now recognise the fact that the market momentarily indicates its own immediate future, and that these indications are accurately recorded in the market transactions, second by second, and therefore Those who can interpret what transactions take place, second by second or moment by moment, have a distinct advantage over the general trading public. And then Tom Williams, he was born in 1929 and passed away November the 7th, 2016. He said, if you can read a chart correctly, you will understand the markets do not move randomly, but are moved by the smart money. And you can see their intention at support and resistance levels by looking for the telltale footprints hidden in the volume and price. And you have a chance to profit by following in their footsteps. Volume is vital in your analysis, which is why the self-regulated exchanges around the world will not release the true volume information until the next day, which is very interesting. So if you want to find out more about the methodology, we have a website. It's volumespreadanalysis.com. It goes through all the detail that I'm not going to be able to cover in an hour's presentation. But simply put, VSA, volume spread analysis, looks at the activity in the volume, the spread of the bar. Don't confuse that with the bid-ask spread. It's simply the high and the low of the bar. So the activity is the volume, the high and the low is the price bar, and then, of course, the most important part is the closing price in relation to that volume. Very important. So volume is activity, and we're interested in volume because it tells us the consensus of opinion amongst the big players. And the spread of the bar, the high and the low, and the closing price, especially when you look at what's going on in the background. Do you have a downtrend? Do you have an uptrend? Are you range bound? All of these things are relevant. Does it work in Forex? Absolutely it does. If I was able to show you my screen there, you'd have seen it working in MT4. I think at the beginning of the presentation you did see that. But I'm not able to check. I'm on two separate computers. But I will show you in the currencies on the futures exchange, because I trade that as well. So yes, it works for Forex because it uses tick volume. And tick volume is extremely powerful. In fact, if you can read tick volume in Forex, you definitely get an edge over the general paper trading public. So what I'm about to show you in the next 10 minutes, before I hand back over to Simon, is the concept of finding trades using what we call scan, confirm, and trade. Now remember, we're scanning for unusual volume activity followed by low volume activity. So we're identifying trading opportunities by finding, first of all, the Yao Ming volume, the unusually high volume. We call it climactic in Trade Guider, followed by low volume at a similar or same price level where the high volume appeared. And that's very relevant, as I'll show you, to show visually clear trend alignment in multiple time frames. Massively important. I'm often asked, Gavin, which chart do I look at? The 1 minute, the hourly, the daily, the weekly? You look at them all and you choose the ones that make sense. And I've, from years of experience, have worked out you start with the weekly, then you look at the daily, then you look at the 8 hour, then you look at the 4 hour, then you look at the 60 minute, then you look at the 15 minute, and when they all align, you start to get trades in harmony with the flow of price. Price is like a river. It flows up river or down river, or it goes into an eddy, which is what we call congestion. We don't trade congestion at Trade Guider, we stay away from it, and we have a way of identifying it. And then when we see a key principle appear, which I'll show you, our software will email you and tell you it's there. So if you're not by your computer, you're not going to miss a trade. And because you can now trade from smartphones, many times I've traded while I've been in a supermarket. I know that sounds odd, but I have. Because if you see a very important principle based on volume spread analysis, you want to be in the market as it appears, not 10 minutes later. And then when we see what we call a sequential trade setup appearing, it will also alert you. Now, you're going to get a copy of my second book, no charge. It's a PDF which explains these setups. So you're going to get a lot of information here at the end, which will, again, there's no obligation on your part at all, other than we just ask you for your email address so we can email you an invite to our trading room. That's it. And that's free as well for a whole week. So once you have this system, you can monitor hundreds of charts, which a human being can't do. And the system then sniffs, we call it the sniffer at Trade Guider, it sniffs out opportunities and alerts you when those opportunities are here. It also shows us when the market's in congestion. Congestion means don't trade. And when the scanner is misaligned in different time frames, it just says don't trade. It's just as important as telling you when to trade. It tells you when not to. When the scanner is aligned, there's a trade setup. And then you get alerts. We've got them for MT4, we've got them for TradeStation, for Metastock. No, not for Metastock yet, but we're working on that. For NinjaTrader. But MT4 is the most popular platform, and that's the one that, unfortunately, you couldn't see on the other computer, but I use a lot. And tomorrow, in the live trading room, when Donald Trump gets in, we're going to have some very big volume coming in. So if you can make it for the tomorrow session, you're very welcome. And again, I'll repeat, there is no obligation and no charge on your part. The bar information tells us what's happening. So the market participants, who are they? They're the group that lose. We call them the herd in my book and in Tom Williams' book. Not being derogatory, it's how the markets have to operate. The market has to have losers. We want to make you this, a predator, a clever predator, one that understands the truth about the markets and one that understands how, when professional money move into the market, they don't buy as the market's going up, they sell. And they don't sell as the market's going down, they buy if they're bullish. So, as I show you this, I've got about 7 minutes left because I don't want to overrun because I know there's another speaker coming in. You will soon be able to trade with the smart money. Let's get to the charts. All right, so we're going to start off with the Dow Jones. All right, now what we can see on the Dow here, all right, is the principles I just showed you. All right, now, first of all, I'm going to talk about why the market's going down in the Dow, which it is. Okay, and I've been short on this contract 3 times today. Now, first of all, we start with what happened this morning. Notice, well, let me ask you all a question, okay? Yeah, John, I can't show you, unfortunately, the FTSE. It works beautifully with the FTSE, but we will show that in tomorrow's live trading room. Yes, it works for stocks. I'm actually a fund manager for stocks. That's my main thrust as a fund manager, not just trading futures, but stocks as well. It works brilliantly with stocks. And in fact, I use TradeStation to use our scanner, what we call our sniffer, which is here. Okay, this is the Smart Center Pro. Imagine these are all stocks in the FTSE. You can see at the moment that we've actually got alerts coming in on the Japanese yen, and it's flashing. And that means it's seen a sign of weakness. And also on the Dow here, right, we can see on the 5-minute chart, it picked up this signal here, which is where I went short as it happens. Okay, now this is in a downtrend. Notice the weekly chart's going up, but the 8 hour, which is this is the M stands for minute, by the way. The 8 hour, 1440. Okay, here, the 4 hour is negative. The 60 minute is negative. The 15 minute is negative. The 5 minute, which sent the alert to me, okay, is also negative. We left click in the Smart Center Pro, it brings up what we call the scanner. Now, in simple terms, what this does is it shows me where the weakness is in the trend. Now, if I look at the daily chart, first of all, I can see for the last 6 days, we've had no demand that happened over here last week. We had supply coming into the market, which means sellers were present, and we've been going down now for a few days. It's been negative. We can see over here on the 4-hour chart that about 4, 6, 8, 24 hours nearly ago, no demand. No demand is weakness, as I'll show you in a minute on that time frame. I like to swing trade the markets, okay? So I like to hold positions. I do hold positions overnight. Here we can see the trend is very much down. No demand again, which is, what does no demand actually mean? It means no interest in higher prices at that particular moment in time. And I'll show you it on a chart in a minute. And then over here on the 1-minute chart, and yes, you can use this for scalping, something called a trap. So let's go and look at all of these. And what we're looking for, remember, is when the market's heading down on the big time frame and the small time frames, we're looking to short the market. Hence the red signal and the market falling. It's very logical. And you can actually see here on the screen that I'm actually short on the Dow on that signal. Okay, hasn't moved much because obviously the Trump election or the Trump inauguration is causing the market not to move very much. Nevertheless, if it moves below the support line, right, which is just here, where the strength came in, if it moves below this level here, it's going to come right the way down where the buying happened. There was the buying this morning. Okay, so they bought the market on the low, hence a green signal. Imagine if that's all volume that's selling volume, we couldn't go up the next bar, could we? Impossible. Couldn't happen. And now we're breaking down. So what we're going to do, okay, we're going to look and see where the likelihood of this market's going to go. Now, this is a real account. I trade a live account. Obviously, we're registered. Okay, and I'm only trading one lot because this account's only $5,000 US. We do trade big size. In the trading room, Steve is trading a $350,000 account. That puts some people off. Okay, it doesn't put me off, but it puts some people off. So I often trade just one lot to show people how you can do it on a one lot trade. Now, reason for the trade, right? Let me be very, very clear. Here is the weakness on the up move. Here is the no demand bar, which was the entry. I put my order just below the no demand bar. And the market has fallen because of this bar. Now, notice, this is high volume on this bar. Okay. Now, I'm going to move that stop to break even, by the way. So there's no way I'm going to lose on that trade. And what we're going to do is I'm going to show you why, before I finish here, why high volume and low volume at the same price level is incredibly relevant. Here, you can see the high volume. Okay, there it is. It's an up bar, closing near the low of the bar, so just below the middle of the bar. Okay, now notice the volume's incredibly high here. Okay, now you should all have audio. I think you have. Now, what happens is the market is in a downtrend. How do we know that? Smart Center Pro has alerted me to short the market based on no demand in a downtrend. Red, 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 red. These diamonds and this system is completely proprietary to TradeGuider. You will not find this anywhere else. This is not based on mathematical formulas. It's based on bearish volume and bullish volume. We're currently in a bearish volume situation. In a bearish volume situation, we wish to short the market. We have no demand, so where the sellers came in here, which we can clearly see at the top of this bar, let's just erase that for a second. Okay, so where the sellers came in here, we have an indicator. Let me just get rid of that for a sec. There we go. Where the sellers came in here, it tells me supply has come into the market. That means sellers. Most retail traders, seeing the market spike here, will be going long. We'll be teaching you to do the very opposite. That's what we teach you at TradeGuider. We teach you how to follow the smart money, to trade in harmony with the smart money. Over here, however, where the entry was, we go back up to where the sellers were present, but look at the volume. There's no interest in the higher price. See here? No interest. This is called no demand or no interest in higher prices. And it's got a VSA principle there. No demand. I'll read it to you. It's an up bar, right? Which means a price bar that's closed higher than the close of the previous bar. An up bar with volume lower than the two previous bars shows lack of interest as the market rises. By the way, these are live charts. This is not a PowerPoint. I'm not showing you stuff that happened yesterday. This is real. This is right now. And I can't prepare this stuff, right? The market either gives you the alert or it doesn't. So I've done presentations where nothing happens, and I've done presentations where we've taken 8 trades in 20 minutes. Tomorrow we're going to be taking 8 trades in 20 minutes. There's going to be a big move tomorrow, by the way, in gold, just so you know. So study the background carefully and look at the trend. The trend is down. So I'm trading in harmony with the trend. This is the medium-term trending system, the thermometer. And down here we have all of these things that are red are proprietary to the TradeGuider software program. Okay. This indicator works best when there is weakness in the background. Okay, now think about that. It's telling you, it's intuitive, it's telling you weakness. That is weakness in the background. It happened an hour and a half ago, but it's still relevant to what's happening at this price level. And you're seeing for yourself what the market's doing on that weakness. That is no demand, no interest in higher prices after sellers have come in here. This is an up bar showing an increase in volume. Supply has entered the market. If volume is ultra high, which it is, it's climactic, which is sign of weakness in its own right. And that is why you're watching live as the alert has come in the Smart Center Pro. And there you have what we call the up thrust on the 1 minute chart. Again, all these symbols are described in my book, and you'll see it here. That was the catalyst for the downward move, the up thrust. Okay, 3 minutes left. Let me leave you with this thought. And I know Simon, I'm sure, will send this out to you as well. We're going to give you an opportunity to join us for our live trading room. There's no sales pitch here. This is all for nothing. We don't want anything from you other than to invite you to our live trading room with real money. Again, you're going to see me trading Forex and futures tomorrow. Specifically, I'm going to be trading the British pound and the euro tomorrow for a very specific reason that I won't share here publicly. You'll get 1 week's access to the trading room, okay, which you can get details of that here. And you'll also find details of all of this. We'll have a lozenge under it when you register so you can see the software. But you'll also get the mentorship course and the manual for the Trade Guider program without even owning it, so you can see it for yourself. And there is absolutely no obligation on your part. Okay, so all you need to do, Simon, I think Richard sent you the link. If you could post that in the room, it's just tradeguider.com/RTC. I think that's, I don't know if you can post that. Just www.tradeguider.
Yeah. Kevin,
thanks, Simon.
We posted it just five minutes ago, actually. I've just checked it.
Okay,
it is working.
I've just seen it.
Yeah.
I've just seen it.
Yeah.
So in summary then, everybody, I'm going to hand back to Simon. I'm not going to overrun. And thank you, Simon, for all the work you do. I think you do a super job. We will follow up with you guys, obviously tomorrow in the live trading room. Once you've registered later on this evening, and you need to register in the next hour, because then we're going to close it off because we've only got 500 seats. We have 500 seats in that room. Close it. You're very welcome to come and join us. And Simon, we'll touch bases soon. Hopefully we can go for lunch again sometime shortly. And to all of you, I wish you good trading, constant profit. God bless.
Gavin, thank you very much indeed. And yes, that lunch, we must get that in the diary very soon. But thank you for joining us tonight and finishing almost perfectly on time.
Cheers.
True professional. Okay. Okay, I think I'm going to take the screen back. I think Gavin's muted himself. Okay, thank you very much indeed, Gavin Holmes from Trade Guider, and we are now at 7 p.m. here in the UK. Thank you for joining us. We still have a great number in the room. We've had about 700 people so far attended today's webinar, still with about 160 people in the room. So thank you. If you're one of those that have been here since the morning, thank you. Appreciate the company. If you're just joining us this afternoon or this evening, everything has been recorded, so you'll be able to get a copy of all the sessions that you haven't been able to see so far. And if you're able to stay with us till the end, we'd appreciate it. Or if not, you have to leave tonight. We will send you a link to the recording as soon as it's ready. That will be tomorrow, and thereafter the individual sessions will be available on roundtheclocktrader.com. So moving ahead, we are still in live play, as they say, and I'm happy to say that our next speaker is from the Forex world. He is a Forex trading expert. His name is Martin Walker, and as we've just seen, I think 90 to 95% of you all here are into Forex trading as your preferred instrument for trading. So this really is the one to watch. How to conduct multi-time frame analysis and find hotspots or confluence in the market from which to trade. So Martin Walker from Forex Trading London is joining us, and we're just on 7 o'clock now. So let's see if we can go straight over to Martin. I can see that he's in the room, which is fabulous. Always makes it easier. Click a couple of buttons, and as if by magic, we should be able to say good evening to Martin.
Good evening. Can you hear me?
Yes, I can hear you. Martin, good evening to you. How are you?
I'm fine, thanks. Very good. Thanks for having me.
Oh, it's a pleasure. I wanted, sorry, if I could just, we've got a couple of questions coming in, just saying there's a link from the previous speaker. I want to see if you're having issues with it. If you could keep trying, it is the right link. So perhaps try it in a different browser or something like that, Ian, if we've got a problem there. So, Martin, I'm sorry about that. Okay, let's move on. How are things? It's been a couple of months, I think, since we spoke. I know you spoke at our event last year, and you've taken part in one or two of the webinars previously as well, which is great.
Yep, everything's fine. So just thought today I'd just do something a little bit different, and rather than just share a PowerPoint presentation, I thought I'd just get the charts out and we'd go through some analysis. I'll do a quick intro on some PowerPoint, but then we're just going to go and look at some charts, and I'm just going to show you what I do. Okay.
Fabulous. That's what we're looking at today. We've got a very active audience in the room today, which is great. You should have a button now. Accept the presentation. There we are. I can see the slide. First of all, Forex Trading London, and that's a nice sunny day. Not like today, I suspect. In London.
It was sunny It was sunny where I'm living, but there we go.
Pollution warnings were out, I think, in the city. It was freezing fog. So yeah, that's great. Yeah. Well, Martin, I know you run Forex Trading London. Can you just, as we start off, just explain to people what the company is and what you offer, and then we can get started. So I'll hand over to you.
Okay.